The other big market story today is Warby Parker going public in a direct listing. We are still waiting on the first trade in the New York Stock Exchange. They're trading under WRBY. While the company started as a direct-to-consumer play, it's been rapidly expanding its brick-and-mortar footprint. Warby's co-founder and co-CEO outlined that strategy earlier on Squawk Box.
So we have around 150 stores today relative to thousands of stores that most of our larger competitors have. And the category has trailed a lot of other consumer goods in terms of e-commerce penetration. It's still in the single digits, and we have the opportunity to really scale through our leading offerings like our virtual try-on and our virtual vision test. And ultimately, we don't care where a customer transacts. We just want to make sure that they have the best experience possible.
So how did brick and mortar go from being a dinosaur to the future of e-commerce retail? Joining me now is Jan Kniffen. He is the CEO of Jay Ritter Kniffen Worldwide. Jan, long live brick and mortar.
For sure. When these guys started, they were online and they were a fashion retailer. Now they're brick and mortar, and maybe they're a healthcare company because they're doing contacts, they're doing eye exams, they're grinding their own lenses. That's a big change from 2010 to now. So I find it very fascinating that the growth looks like it's all going to be coming, or not all going to be coming, but a big chunk of the growth is going to be coming out of the brick and mortar side. And they intend to build a lot more stores. And they're building them pretty fast, which tells you what we need to know is that everybody needs online and everybody needs brick and mortar, and one supports the other. They figured it out relatively early on.
Yeah, they've been doing this for a long time. It's just so interesting because how many times have we seen the stories, the death of mall, the death of brick and mortar, the death of the downtown? I mean, it is reassuring and encouraging that brick and mortar is so important to a company like Warby Parker. Our friend Simeon Siegel over at Nomura has been pointing out that you basically cannot exist in a profitable, sustainable way as an e-commerce play these days without a strong footprint. Why is that?
Well, Amazon's telling us the same thing, but the why is that is because a couple of things happen. Sales around a store online are a lot better than sales when there isn't a store there. Some of the reasons are the support of the store. You can take it back to the store. You can pick up at the store. There's lots of things going on with that. Another reason is the billboarding effect, because people know you exist when there's a big store there. So they'll look for you online. So we haven't quite figured out the whole dynamic, but clearly when you close a store and you're an online player as well, sales around that store online go down. And Macy's has figured it out. They've been very careful about where they keep stores and don't keep stores because they know it affects the online business. So there's been a lot of work done there. I wouldn't say we're definitive, but almost everybody, including Amazon, has figured out that if you're selling online, you still need stores.
And we're going to talk more about that in a moment. But Jan, as we're speaking, Warby's open for trade. These direct listings typically take a little bit longer to open. So here we are, 1:11 p.m. Eastern time, and they're trading around $54. I think the reference price was $40 in this one. You kind of look at that as analogous to the IPO process. So a 35% gain for WRBY. Quick final question, more just about Warby specifically, but as a buyer of very expensive contact lenses, I think my last order was about $500 worth. Maybe that was a six-month supply. Are they going to be able to bring down price and get a lot of market share in this area? And what does that mean for the incumbents?
Well, they clearly think they can because it's only about 1% of their business now, just like eye exams are only about 1% of their business now. They believe there's an open field for them because they think that they can do the same thing that they did in the eyewear. And I suspect they can. There's a pretty big umbrella out there on pricing for all of those kinds of goods. So I believe they will get real growth there as well. And I think having stores will help that too. But their real business is still going to be being a public benefit company that sells glasses. And I think it's interesting that they're trading well above the reference price because that puts them well above a $5 billion valuation. And people were hoping they would be something more than a $3 billion valuation. So it tells you what the world is thinking. They seem to like this public benefit company.
Yes, they do. Jan, are you wearing Warby Parkers right now?
I am not. I don't own a pair of Warby Parkers, sad to say.
Oh, come on. I guess that shows there's still plenty of room for growth. Jan, it's great to have you here today. Thank you so much. We appreciate it.
There's always room for growth when you got 1% of the market share.
Yeah, that's true. At a $5 billion valuation at that. Jan Kniffen with Jay Ritter Kniffen Worldwide.